Ready to pass the CPA exam faster? Visit cpapass.ai. Today, mastering payables and accrued liabilities, the cutoff rules that save your score. An examiner's favorite way to tank your FAR score is testing how you identify and cut off liabilities at year end. Misstating what a business owes distorts the entire balance sheet. Today, we will master the core rules of payables and accrued liabilities, establishing when an obligation is legally incurred versus when cash changes hands. We will set clear objectives for trade payables, interest accruals, and unearned revenue. Plus, we will preview advanced topics, including our signature four-step asset retirement obligation mental map and the highly tested exit or disposal liability traps. Let's master these rules. To secure these points, you must know what triggers a liability. Under GAAP, three strict conditions must be met: a present obligation arising from a past event, requiring a future sacrifice of economic resources. Accounts payable represents informal trade obligations to suppliers for goods or services already received. A classic examiner trap is trying to make you record a liability when a company merely places a purchase order. Remember, a purchase order does not create a liability. No journal entry is made until the goods are actually received or legal title transfers. This is where the money trail begins. Cutoff testing hinges on shipping terms. Under FOB shipping point, title and risk of loss transfer to the buyer the moment the carrier accepts the goods at the seller's shipping dock. This means the buyer must record the inventory and the corresponding accounts payable while the goods are still in transit. Conversely, under FOB destination, title transfers only when the goods physically arrive at the buyer's warehouse. If goods are in transit at year end under FOB destination, the buyer records absolutely nothing. Always look for the physical arrival date versus the shipment date to determine if a year end liability exists. This distinction is heavily tested. Well, let's look at the actual journal entries. When a company purchases inventory on credit, we debit inventory and credit accounts payable to establish the liability. When we settle the obligation, we debit accounts payable and credit cash. At year end, if goods are in transit under FOB shipping point, we must record an adjusting entry: debit inventory and credit accounts payable to reflect our legal ownership before the books close. If the terms are FOB destination and the goods have not arrived, we make no entry. Accrual accounting is about recording what you owe when you owe it, not when the invoice is paid. Examiners love to set traps with year-end cutoff scenarios. The first trap is recording a liability too early by accruing an FOB destination shipment that hasn't arrived by December 31st. Always verify the physical arrival date. The second trap is excluding an FOB shipping point shipment from year-end payables just because it hasn't reached the warehouse. To solve these, follow a simple three-step process. Identify the shipment date, find the arrival date, and check the shipping terms. If a shipment left the dock FOB shipping point on December 30th and arrived January 3rd, it must be included in your December 31st accounts payable. Master this cutoff to save your score. To recap, accounts payable represents unpaid supplier invoices where goods have been received or title has transferred. Remember, FOB shipping point means it is the buyer's liability as soon as it ships. FOB destination means it only becomes a liability upon physical arrival. Never accrue future operating losses or record liabilities on a mere planned commitment date. For accrued expenses, remember our rule: no bill, accrue it still. To practice these cutoff rules and master task-based simulations, head over to cpapass.ai to test your knowledge. Keep your liabilities accurate, and you will secure these easy points on exam day.